If you are joining us for our webinar for the first time, my name is Rotimi Olawale. I'm the Chief Market Analyst for PU Prime and Head of Education for PU Prime Lagos. And today we're looking at multiple time frame analysis. You can call it multi-time frame analysis, still the same thing. And it can also be called top-down analysis. All right, so let's get started. Now, this topic today is for every category of trader, whether you're a beginner, you are intermediate, or you are advanced, regardless of the level you are, you will learn a couple of things or the other from this training this afternoon. So what is multiple time frame analysis in Forex trading? Okay, Dowda is saying that I never had the opportunity to join this training. I believe it meant in the physical class, but yeah, they're online, either physically or online. What is important is that you get the information and supercharge your trading with what we're sharing this afternoon. So we said that multiple time frame analysis is a trading approach that involves studying a currency pair across different time frames before making a trading decision. Instead of relying on a single chart, traders analyze the same market from multiple perspectives, such as higher, medium, and lower time frames, to align long-term trends with short-time trading opportunities. This technique helps filter out false signals, improve trade timing, and increase overall accuracy. Now, generally for a lot of traders, especially beginner traders, most of the time, what they do is that they start analyzing the market on just one chart. You know, when you see somebody trading on only 1 hour time frame or only on 15 minutes time frame, you know that person is most likely a beginner trader. You know, a more experienced trader knows that it needs to check out price on different time frames before it can take a decision on whether it wants to buy or sell. Because what we do, you know, in trading, especially with multiple time frame analysis, is that we look at the higher time frame. You want to check out the direction on the long term trend of a currency pair, then we'll go over to the medium term and we'll make our entry on the short term. That is simply how we do multiple time frame analysis. So if you're used to just analyzing on one time frame, I'm telling you critically now that it is very, very wrong. You know, you will get a lot of inconsistent results if that is your trading style. So after today's class, you want to implement what I'm going to teach you this afternoon, and you will see that your trading will change. You will start making profit more consistently. You know, one of the reasons why traders have this challenge of making profit today and losing it tomorrow is because they are looking at just one time frame. You know, you will see buy this minute, the next 20 minutes, you are seeing sell on the same currency pair. It doesn't work like that in the market. You know, you need to first look at the higher time frame, medium time frame, and the lower time frame. If all of them are aligning and saying the same thing, that is going in the same direction, that is the only time you trade the Forex market. And that is just what multi-time frame analysis or top-down analysis, that is just what it's all about. Now, if you have not heard the word multi-time frame analysis before, maybe you have heard top-down analysis, it's still the same thing we're talking about. All right, if you have a video feed on, kindly put it off so that it doesn't drag our bandwidth for this class. I appreciate that. Okay, so why multi-time frame analysis matters? Why does it matter? The number one reason why it matters is in terms of the market context. The higher time frames, that is the weekly, daily time frame, reveal the overall market direction, market strength, and key support and resistance zones. If you have ever been a part of my analysis session, you will confirm that the first time frame I always check is the higher time frame. I want to see what is happening in the big picture, because the higher time frame, like the weekly time frame, can give you a long-term trend, you know, a long-term bias in the market. With the higher time frame, like weekly time frame, you can know what will happen the entire week. You can know the direction that instrument is expected to go. Now, if you also add the daily to it, it's still very good. So you look at the weekly or the daily time frame to know the overall market direction, the trend strength, and the key support and resistance zones. Why do we check these zones? Because if the market has an overall bullish trend on the weekly and daily time frame, then you are assured that for the better part of that week, the market will go in the bullish direction. So you are only looking at the 1 hour or the 4 hour time frame to make entry in that direction only. You are only trading in that direction either for the day or for the week. So the market context is the number one reason why we look at multiple time frame analysis. The second reason why we look at multi-time frame analysis is for trade timing. Lower time frames like 1 hour, 15 minutes, 5 minutes, refine entry and exit point. So when we've gotten the direction of the higher time frame, then we'll come to the lower time frame to make our entry. So the higher time frame will give you direction, while the lower time frame will help you to identify the right entry, the right timing to make entry. Third reason why multi-time frame analysis matters is risk management. Multi-time frame analysis reduces the likelihood of trading against the dominant trend, minimizing unnecessary losses. Like I said earlier, one of the reasons why many people are not profitable with trading is because many people use just one time frame. You're trading just a 15 minutes time frame. 9 a.m. you see a buy, 10 a.m. you see a sell, 1 a.m. you see a buy again, 3 p.m. you see a sell on the same time frame. No, that's not how to trade. But if you are looking at the daily time frame, the daily time frame may just give a buy. So if you buy only for that day because of what you are seeing on the daily time frame, you will make more consistent profit rather than just on 15 minutes they're giving you buy, sell. You make profit now, the next trade you lose it, you make it, you lose it. So multi-time frame analysis helps us to apply risk management effectively. Also, clarity. By zooming in and out, traders can avoid being misled by short-term noise. Many times, the short time frame, like 15 minutes, 5 minutes, 1 minute, can be regarded as noise, except if you're a scalper. That's a whole lot of difference. But then generally, they are regarded as noise. So when you're looking at the higher time frame, like I just used the example of the daily time frame now, then you know you're trading, even if you're making your entry on 15 minutes, you know it's in line with the big picture of what is happening on a higher time frame, higher time frame like daily time frame. So that makes you to have more consistent results as it reduces the noise in your trade. What is the importance of multi-time frame analysis? Number one, determining the market context. Higher time frame reveal whether the market is trending, consolidating, or reversing. And this is very essential. On the daily or weekly time frame, you can identify rather if the market is trending up or down, or whether it is consolidating. Consolidation means when there is no direction in the market. You see, there are three types of trend. We have the uptrend, we have the downtrend, we have the sideways. The sideways market is also called a consolidation or range. So you can call it consolidation, range, or sideways. Now, in an uptrend, the market is trending higher. In a downtrend, the market is trending lower. And in a sideways, the market is just going sideways, which is consolidation, no definite direction. So if you have cited a range on the daily time frame, then you know that you are supposed to maybe stay out of that particular trade because the market is in consolidation. Do you understand? So if the market is trending up on the daily or weekly, yes, you know the market will go, the price will go higher. If it's trending downwards on the daily or weekly, then you know that by the time you come to like 1 hour time frame, you can see opportunity to sell because the market will go in that direction. So one of the importance of multi-time frame analysis, it helps to determine the market context. It helps traders to avoid taking positions against the dominant market direction. So in an instance where the market is trending up on the daily or weekly time frame, in such instance, please listen clearly. You don't have any business with a sell trade. A sell trade is invalidated, the sell signal is invalidated if the market is buying on the daily and the weekly time frame, because that sell signal is a short-term trend. The market will over time reverse and go in the major direction. So that is why this thing is very important. Only trade in the direction of the higher time frame. So you use the higher time frame to know direction and the lower time frame strictly for entry. Number two importance of multi-time frame analysis is identifying strong support and resistance zones. Key levels drawn on daily or weekly charts often act as decision zones where the market reacts accordingly, where the market reacts strongly. If you have identified a support zone on the weekly time frame, I can tell you for a short, for guarantee that the market will go in that bullish direction the better part of that week. You know, somebody has asked, not even somebody, many people ask most times that my chart is so clean, I don't have too many indicators. Some even say maybe I only use trend line. Well, I use trend lines a lot. I use support and resistance a lot. But most importantly, I also use multiple time frame analysis. That's why in my analysis, you will hear me talk about different time frames I start from the weekly, daily, I go to 4 hour, I go to 1 hour. What am I trying to do? I'm trying to identify the overall direction of the market in all of these time frames. So if you ever find price, on the weekly time frame to be bullish, to be around the support zone, to be at a key level, take note of that, because that is where the market will go the better part of the day or even the week. Next point here says lower time frames can then be used to refine entries around these levels. We've mentioned that. Another importance of multi-time frame analysis is enhancing entry and exit with precision. Traders can enter on pullbacks or breakouts identified on smaller charts. That's after you have identified the direction on the higher time frame. All right, Emmanuel, Nathaniel is saying your voice is breaking. I don't know if it's from me or from you. Okay, so I want to be sure if he's the
It's
only
not
one
breaking.
experiencing that. Okay,
It's not
others are
breaking.
saying it's not breaking. So, Mr. Nathaniel, maybe you can log out or log in, or maybe you refresh your internet. Maybe it's your network that is giving that issue, because people are saying from my end here that everything is fine and perfect. So multi-time frame analysis help us to enhance our entry and exit with precision. Another importance of multi-time frame analysis is filtering out market noise. It helps us to filter out market noise. Short-term charts alone can produce false signals due to volatility. Yeah, back to trading with only one time frame, like 15 minutes time frame. It's a lot of noise. Multi-time frame analysis ensures signals are validated by higher time frame structures. Strategic flexibility. Multi-time frame analysis allows traders to adapt strategies for trending, ranging, or reversing markets. And that's a fact. When you use multi-time frame analysis, your trading becomes very flexible. You know when you are trading when the market is trending, you know when to stay out when it's ranging, and you know when to capture reversal move in the market accordingly. It makes trading a lot very, very flexible. Now we want to look at multi-time frame analysis and risk management. Now, in whatever you do as a trader, risk management is a must. You must take note of risk management. Is one essential part of trading that you cannot neglect at all. Now, risk management is one of the biggest advantages of multi-time frame analysis. How does that happen? By avoiding counter trend trades. Trading against the higher time frame often results in stop loss hits. So with multi-time frame analysis, you tend to stay out of counter trend trades. What is counter trend trades? The market is going bullish. You decide to take, a bearish trade. You're following a bearish signal. Now, if you're using multi-time frame analysis, for example, if on the weekly time frame, the week started with price, at a resistance level on the weekly time frame, it's at a resistance. You are looking for opportunity to sell. You cannot be buying. Otherwise, you're ready to get your stop loss hit. So it has already given you direction. So all you need to do is to, if you have found resistance on the weekly time frame, then go to the daily 4 hour and maybe possibly 1 hour to look for entry in the bearish direction. You don't have a need for any counter trend trade. Once price is at the resistance level, your trend is already defined as bearish. Taking a bullish trade is as good as a suicide mission, because that will be a losing trade. So in terms of risk management, multi-time frame analysis help us to avoid counter trend trades, and it minimizes our stop loss being hit. Two is that multi-time frame analysis minimizes this by ensuring alignment across time frame. So all you are ensuring with multi-time frame analysis is alignment. What do you mean by alignment? It means you are only looking out for scenarios where price is going in the same direction across multiple time frame. Meaning, if you are seeing a bullish trend on the weekly, you must see a bullish trend on the daily, you must see a bullish trend on 4 hour, or you must see a bullish trend on 1 hour, depending on the style of trading that you adopt. So maybe if you're a swing trader, you're looking at a bullish trend on weekly, daily, 4 hour. If you're a day trader, you're looking at a bullish trend on daily, 4 hour, 1 hour, on and on like that. So you must ensure alignment in terms of direction. Number two, for multi-time frame analysis and risk management is better stop loss placement. Support and resistance zones from higher charts provide stop loss levels, provide logical stop loss levels, prevents overly tight stops that get hit by normal volatility. So in terms of risk management, multi-time frame analysis also helps us to know the best position to put our stop loss, while in many instances you can even utilize support and resistance zones. Also, position sizing discipline by aligning trades. Okay, please, as you're joining this class, make sure you mute your device so that we don't get distracted by the background noise. By aligning trades with major trends, traders can justify holding positions longer, often with smaller risk relative to reward. So it means that with multi-time frame analysis, if you see a trade, you see the trend on a higher time frame and you're making entry on the shorter time frame, then you can ride the big time frame trend, with minimal risk to reward ratio. Also, trade validation. Lower time frame signals that do not align with higher structures can be ignored, reducing unnecessary exposure. For example, you see a bearish trend, you see price at a resistance on daily time frame, which is bearish. On the 4 hour, you see bearish, but on 15 minutes or 1 hour, you see bullish. You don't take such a trade until that lower time frame of 15 minutes or 1 hour aligns with the bearish direction that you found on the 4 hour and the daily time frame. So you use it to validate your trade. So these are ways we can use multi-time frame analysis for risk management. So how multi-time frame analysis affect different categories of traders? For scalpers, now scalpers are fast-paced traders and they look at 1 minute, 5 minutes, and 15 minutes charts to trade. So impact, multi-time frame analysis prevents scalpers from trading against strong trends. So for the scalper, his highest time frame is 15 minutes. They often check 1 hour or 4 hour charts to align scalps with a bigger market flow. So scalpers can use the 15 minutes, the highest of that, to make entry. They can also look at 1 hour, 4 hour to identify the bigger picture of trends. So the benefit is that it reduces the risk of whipsaws in choppy market. So a scalper may look at 1 hour or 4 hour to know whether the market is trending up, and they use either 15 minutes, 5 minutes, or 1 minute for entry. So they are trading, even though they are scalping on the lower time frame, they are still using the 1 hour and the 4 hour to know the direction. So they are only placing trades in the direction of the 1 and the 4 hour. So it helps to reduce risk of whipsaws and choppy markets. For day traders who trade between 15 minutes to 1 hour for entry, day traders need both context and precision. They typically analyze daily charts for direction, then execute the trade on 15 minutes to 30 minutes, sometimes on 1 hour. So the daily charts is used to know direction, while entry is made on either 15 minutes, 30 minutes, or possibly in some instances 1 hour. Benefit, it ensures their trades align with intraday momentum while respecting the higher level zones. Number 3, swing traders. This look at the 4 hour to daily charts. Multi-time frame analysis helps swing traders identify high probability setups. They analyze weekly charts for the major trend, daily charts for structure, and 4 hour charts for entry. Now, if you have joined my analysis for the weekly analysis on Mondays, this is exactly how I personally analyze the market. I give you the analysis for the week by checking the weekly charts, confirming the trend on 4 hour, and looking for entry look at the weekly trend, confirm the trend on daily chart rather, and look for entry on 4 hour. Benefit, allows them to hold position for days or weeks without being shaken out by intraday volatility. 4, position traders or investors, weekly to monthly charts. Impact, position traders prioritize the macro trend. They use monthly, weekly charts for direction, daily charts for refining entries. And multi-time frame analysis helps them avoid premature entries and manage long-term risk effectively. So position traders are long-term traders. They look at a big time frame, the monthly, weekly, Then they make entry on the daily, and they can leave the trade to run for weeks or sometimes for months, and they can do that confidently because they are using the approach of the multi-time frame analysis, or otherwise called the top-down analysis. From top-down analysis, we only mean that we're looking first at the big picture. We're looking at the higher time frame to know the trend, then the intermediate trend, and the entry on the lower time frame. All right, so we want to look at this approach of top-down analysis or multi-time frame analysis on a three-tier level, three-tier approach. A common method of multi-time frame analysis uses three layers of charts. The higher time frame, which defines the main trend and market structure. Example, you can use the weekly or daily. The purpose of this is to identify whether the market is bullish, bearish, or ranging. That's the purpose of the higher time frame, the daily, weekly, to know whether the market is either bullish or bearish. Now, the intermediate time frame. This provides setup and confirmation. Now, this includes the 4-hour and the 1-hour time frame. You can use them for entry. Sorry, confirmation rather. Purpose: to spot consolidation pullbacks or continuation patterns. And finally, we have the lower time frame. This pinpoints exact precise entry and exit levels, and this includes a 15 minutes or 5 minutes time frame. The purpose is to fine-tune entries, manage stop loss placement, and monitor execution. Now, you can do this depending on how flexible it is for you. You can look at the daily and weekly to identify trend, the 4-hour, which is the intermediate, to confirm the trade setup, and maybe on 1 hour 15 minutes can be used to make your entry. So this is a three-tier approach, meaning we're looking at different time frames, 3 levels to know where the market is going, whether it's going to be bullish or bearish with our entry in mind. All right, let's look at a practical example of this. This is just a theoretical part. I'll still show you the chart side to it. Now look at this example. Imagine you want to trade Euro USD, then you're looking at the daily chart as a higher time frame. The pair is in an overall uptrend with higher highs and higher lows. That means price is really trending up. The 4-hour chart, which is the intermediate time frame, price is retracing to a strong support zone aligned with a moving average. Let's take it a little slower. The daily time frame, price is in an overall uptrend. Price is trending up, is making higher highs, higher highs. That's the daily. Higher highs and higher lows. The 4-hour price is retracing to a strong support zone. So let's say there's a previous support zone where price is retracing to, aligned with a moving average. The moving average is equally pointing upwards. 15 minutes time frame. Bullish candlestick patterns confirm buying pressure at support. Now you can see that everything is pointing towards bullish direction. Overall trend is bullish. Price hit a support. Moving average confirms bull. A candlestick pattern on 15 minutes also confirms a bullish movement. So all this is confirming the same direction. Though different patterns are being seen, but the direction is the same for all of them. This is how we do multi-time frame analysis. So we say in this scenario, multi-time frame analysis helps you align the short-term buy signal with a long-term uptrend, making the trade more reliable. And that's the truth. That is what multi-time frame analysis does. It gives you multiple reasons. It gives you what is called a confluence. That is where you have multiple reasons why you either want to buy or you want to sell. Okay, I will attend to questions towards the end. So divers admin, just exercise some patience. All right, so this is a graphical example. Here we can see GBP AUD on the daily time frame. We can clearly see that price hit a resistance zone on the daily time frame, and we are seeing a reversal candlestick pattern, pin bars or and go, I mean, pin bars, let's call it pin bars, or rejection candles, hitting that same resistance level on the daily time frame. Good evening, Mr. Garba Mukhtar. So the overall direction now is looking bearish because this place is acting as a confluence, a resistance, rejection candles. Now you can see the bullish rejection. The next one to it is a bearish rejection. We're looking at an overall bearish movement on this instrument from the daily time frame. So by the time we go to the next slide, on the 4-hour, we can see a rising wedge pattern. And within that rising wedge, if you're familiar with tools like candlestick pattern or chart pattern, on the lower time frame, this is actually a head and shoulder candlestick pattern with a rising wedge. At the confluence point on the daily time frame, price broke out and you can see a massive bearish breakout. So right from the daily time frame, the direction here is bearish, and on 4-hour, even on 1 hour, is still the same. So that's what we do with multi-time frame analysis. We confirm direction across multiple time frames, the higher time frame, the intermediate, and the lower time frame. What are the common mistakes of using multiple time frame analysis? Because I mean, this is trading. Sometimes we make mistakes. It happens. We are still humans. Now, one of the mistakes people make with multiple time frame analysis is using too many time frames. This can cause confusion and analysis paralysis. So therefore, stick to just 2 to 3 time frames. Now, sometimes some people will analyze up to 5 time frame, from weekly to daily to 4-hour to 1 hour to 15 minutes. That will get you confused. Just stick to 2 or 3. You can do daily and 1 hour, weekly and 4-hour. You understand? 4 hours and 15 minutes. It's okay. That is if you are doing 2 time frame. If you want to do 3 time frame, not bad. If you're doing 3 time frame for swing, you're looking at the weekly, daily, 4-hour. If you're doing 3 time frames for day trading, you're doing daily, 4-hour, 1 hour. If you're doing 3 time frame for scalping, yeah, you can do 4-hour, 1 hour, 15 minutes. You know, it's okay, but avoid looking at 4 to 5 time frames. That is called analysis paralysis. You get paralyzed at the end of the day. You get confused. You end up even still making mistakes that will lead to losing trades. So minimize your time frames to just 2 to 3 time frames. The other thing that can lead to mistake is forcing alignment. Sometimes time frames don't agree. Forcing a trade can be costly. So you've looked at the daily time frame, you see bearish trend. You look at the 4-hour, you see bullish trend. But you say, no, let me place the sell from the daily. But the 4-hour is saying buy. It's bullish rather. You don't force alignment. Wait for alignment to be perfected before you take a trade. And that's where patience comes in trading. A good trader needs to learn patience. If you want to be sustained in this business, patience is a virtue. You have to learn to be patient. Maybe you're checking daily time frame, you're seeing a bullish trend, or 4-hour, you're seeing bullish. Then on 1 hour, you're seeing bearish. You can't place the trade. Some people will say that, oh, let me see the daily and 4-hour, they're saying buy. Let me just buy. Then eventually the 1 hour will reverse and go and make the buy. No, rather wait for the right entry for the 1 hour when the market is trending up in line with the other higher time frames. The third mistake people make is neglecting fundamentals. Multiple time frame analysis should complement economic news and market sentiment, not replace them. So that you're having multiple time frame analysis and it's correct does not mean you should neglect fundamental events. Because if you say, oh, I've analyzed the market, my weekly, daily, 4-hour, everything is right. I mean, it's right in the same direction. I'm looking at an opportunity to buy. But then there's an upcoming news and you decide to ignore the news and place the trade may still come against that trend and you may still end up losing. So it should be used to complement economic news and market sentiment and not to replace them. It doesn't replace fundamentals and sentiment. All right, so here's the conclusion of multi-time frame analysis. Multi-time frame analysis is a cornerstone of professional forex trading. By integrating higher, intermediate, and lower chart perspective, traders can, 1, understand the market's true context, Two, filter out noise. This is very, very important. This analysis helps to filter out noise. Three, time your entries and exits more effectively. And four, manage your risk with precision. Conclusion. Different categories of traders, from scalpers to position traders, can adapt multi-time frame analysis to fit their strategies. So regardless of the type of trader you are, whether you're a scalper, day trader, swing trader, you can make this multi-time frame analysis to fit into your strategy. And you should, not just that you can, you should from today going forward. You should start implementing this to filter your trades. Finally, ultimately, multi-time frame analysis is about aligning your trade with a broader market flow while executing with surgical precision at the micro level. That's big grammar. All we're saying is that with multi-time frame analysis, look for trend on higher time frame and look for your entry on the lower time frame. Stop trading with one time frame. Stop trading it 15 minutes alone or 1 hour alone. Don't trade with 1 hour alone. Look at the higher time frame. You can only buy on 1 hour if 4 hour and daily are also buying. Vice versa if it's a sell trade. All right, so that's going to be the end of this webinar this afternoon. I believe you have picked a thing or two that will make you a better trader from today going forward. And it's so great that this is coming up today, the 1st of September. So you are starting the month of September on a good note, knowing a better way to trade the market and get very good results. Okay, so I'll attend to some of the questions here. Garba Mukhtar, please, recorded version. Of course, you are going to get a recorded version. I'll post it. Just watch out in your WhatsApp group or any group where you got a link for this webinar. The recorded version will be posted here. Wasi Shobande kindly made the recorded version available to enable us rewatch. Please, I don't want you to just rewatch this video. Watch it 3, 4, 5 times. Watch it as many times as possible till everything I've said, has been able to sink into you and you'll be able to implement it. All right, Stanley, please, example on the chat. Now, don't worry. We are still going to continue this same topic on Wednesday with the practical version. This class today is theory. On Wednesday, don't miss Wednesday class. We're going to have the practical session of this multi-time frame analysis. So make sure you don't miss it. On Wednesday, there'll be enough time to show you many charts, many trade setup as it applies to multiple time frame analysis. Can Nazifi Amino, can you use a multiple time frame analysis on PU Prime Soft? What do you mean by PU Prime Soft, sir? I would like to know what you mean by PU Prime, or you mean PU Prime software. Okay, I believe you mean PU Prime software. Of course, you can use it even with any strategy. You can use it if it's the PU Prime software you're talking about. Yes, you can use it with PU Prime software. Wasi Shobande, what time? The time depends on you. What kind of trader are you? Are you a day trader? If you're a day trader, you should be looking at the daily time frame, 4 hour and 1 hour. Daily time frame for trend, 4 hour for your intermediate trend, 1 hour for entry. You are only buying if all 3 time frames are going in the same direction only. And if it's a sell trade, all the 3 time frames must also be giving you a signal that it's going to sell. All right, software as a scalper. Okay, Mr. Nasifi is still talking about the P primes. Yeah, even as a scalper, implement multi-time frame analysis. You will get clearer and high probability trades with that. Where can we get the recorded video? Like I said, after this session, we will upload it to your group where you got the link to this class. What time on Wednesday? Just this time, 4 p.m. We have our online session Monday, Wednesday. Time is usually 4 p.m. So watch out by 4 p.m. on Wednesday for the practical class on multi-time frame analysis. Nii, who is a scalper, please? Okay, there are 4 categories of traders. There are those that are called scalpers, there are day traders, there are swing traders, and there are position traders. Now, a scalper is a fast-paced trader. They leave their trade to run for just a few minutes, maybe from 1 minute to like 5 or 15 minutes, 5, 10, 15 minutes max, and they are not looking for a big profit on the trade. They're looking for just about 5 to 10 pips per trade. So a scalper, and with that, a scalper can take multiple trades within the trading day. All right, so that's it about scalper. Please summarize the multi-time frame again. Okay, it means looking at different time frames to enable you to get clearer perspective about the direction of the market. That's for Mr. Bayo. Meaning, if you're going to buy, you look at the daily time frame, for example. If the market is trending up on the daily time frame, probably is at the support zone on the daily, and on the 4 hour, you are seeing maybe a chart pattern or any pattern that is pushing you to the bullish direction. And on the 1 hour also, all of them are looking bullish. That's only time you trade. That's the only time you take a buy. Now, in that instance, since everything you are seeing from the daily to 1 hour is saying buy, you don't need to take any sell trade, even if you see one, because that sell trade can be a fake out. Multi-time frame analysis reduces your error in the market. Okay, this is not about the software. This is trading directly on the chart. That's for Mr. Abdul Kahar Ibrahim. This is not a software. It's about trading directly on the chart using multi-time frame analysis. Good. Effiong Asuko, please, sir, if 4 hours is bullish, then 1 hour bullish, 15 minutes bearish. How can I trade it? You wait for the 15 minutes to be bullish. That is the whole summary of everything I've been saying. If your 4 hour is bullish, 1 hour is bullish, but 15 minutes bearish, you cannot place that trade. Don't say, let me quickly sell. And before the market reverses, you're deceiving yourself. You will lose that trade. Wait for the 15 minutes to align by being bullish with the 4 hour on 1 hour. That's when you take the trade. That's the summary of everything I've been saying with multiple time frame analysis. It's not compulsory to use moving average. It's not. It's only if moving average is part of your trading strategy. But if it's not part of the trading strategy, it's not mandatory to use moving average. Okay, which moving average to be used in identifying trend as a scalper? As a scalper, you use a smaller moving average now. You can use moving average 5, 5 and 10. Crossover. You can use that. 5 moving average, 5, EMA 5 as a fast moving average, and 10 as a slow moving average. Yes, you can use that. All right, we need to end this class right here so that I can upload the video. I hope you have enjoyed this class today. Make sure you don't miss the Wednesday session. It's going to be explosive. Okay, Dauda is asking, can we be using, what do you mean by TDA? I want to know what you mean by TDA. TDA, trend line, and level zone to be trading profitably. Okay, I need to know what TDA is. Okay, top-down analysis. Oh, you're speaking a big grammar now. Can we be using top-down analysis, trend line, and levels zone? Of course, that's one of the ways I trade. Don't miss our analysis session. This is what we use in trading. Personally, this is how I trade. So don't miss the analysis sessions that we do. All right, I need to end this session right here. Take care, enjoy the rest of the day, and watch out for the link in the in your WhatsApp group, and watch it over and over again. Watch this video over and over again. Okay, people are still dropping comments. But what time frame is good for scalping? Scalping is better on the lower time frame, 1 minute, 5 minutes, 15 minutes time frame. Joshua Chukwu Ameze, if all the 3 time frames like 4 hour, 1 hour, 15 minutes is bullish, should I trade buy or sell? You should answer that question yourself. If all of them are looking bullish, why should you look at selling? Should you buy? You look for opportunity to buy. The last one is the 15 minutes. The moment the 15 minutes is looking bullish and is breaking certain levels, maybe a trend line, your RSI level as confirmation, then you can trigger a buy. You only use the 15 minutes for entry, and the entry should be in the direction of the 1 hour and the 4 hour time frame. You're welcome, Mr. Niyi Adewale. You're welcome. You're welcome, Dauda. What time frame is our last confirmation to enter them? That depends on you. It depends on your trading style. Either you're a scalper, a day trader, a swing trader. I know many of us don't do position trading, so let's not go there. So if you're doing scalping, 15 minutes can be your entry. If you're doing day trading, 1 hour can be your entry. If you're doing swing trading, 4 hour can be your entry. All right, I need to go now. Take care and enjoy the rest of the day. Bye-bye. So you can decide to say